How's it going, guys? This is Forensic Forex with Deontay, and I'm back with another video. This is episode 41 to the Asian Session Library. Once again, with the pair US dollar versus Japanese yen, we had a successful Asian Session model on Tuesday night, the 5th, March 2024. Let's walk through it together. As always, we are not looking to trade between 12 p.m. and 8 p.m. New York Eastern Standard Time. There's been a couple folks confused thinking that I'm marking off 12 a.m. noon. That is not 12 a.m. noon. That is 12 p.m. in the afternoon. Afternoon, 12 p.m., not 12 a.m. noon. This is 12 a.m. noon right here. 0000. That's 12 a.m. Between 12 p.m. and 8 p.m., this is the New York lunch session. This is the dead zone. We're calling this the dead zone because this is where the market is likely to consolidate and accumulate. Market makers or the algorithm is building in market sentiment. Buy stop orders and sell stop orders are building up within these couple of hours. We see it time and time again. Look at any Forex pair and look at 12 p.m. to 8 p.m. and tell me what you see. You're going to see consolidation. And we like to see that because all markets start in a consolidation. We want that. At this point, we're going to mark off all the buy side liquidity pools and sell side liquidity pools. All the ones that are unbroken, of course. We're looking for the buy side liquidity pools above swing highs and sell side liquidity pools below swing lows. I had someone ask me, is there a video for me to define how to see a swing low or a swing high? I am showing you in almost all my videos what a swing high and swing low is. A swing low is a candle that has a higher low on the left and a higher low on the right. You can see that this low point is the lowest point between two candles. That's what makes a swing low. Same thing here. This is a swing low because the candle on the right has a higher low and the candle on the left has a higher low. Vice versa when it comes to a swing high formation. This is a swing high. Why is this a swing high? Because the candle on the left has a lower high and the candle on the right has a lower high. So this is a swing high formation. Hopefully that was clear enough. They come in all different shapes and forms, but the definition of it is that it's a candle between 2 points and it's either the highest point or the lowest point. That's what a swing point is. It only takes 3 candles or 3 bars. We'd like to note off the Asian Open because this is our natural price indication. We don't need any indicators to tell us if the market is overbought or oversold. The opening price is the indication or the natural price action indicator. Once price moves above Asian Open, we are overbought. We're in a premium. And in premium territory, the ideal condition is to sell. It is best often suited for a retail trader to find a short above the opening price in an overbought condition. Vice versa, when price moves below the Asian Open, you're at a discount. The market is oversold. The best ideal condition is normally going to be buys. As a retail trader, we want to buy low, buy as cheap as possible. Let's walk through this together. The model is simply looking for a purge and revert, a turtle soup, a false break, tomato, tomato. We are not looking to chase price. We have no fear of FOMO. If the market starts shooting up 10, 20 pips to the upside, we're not chasing it. Same thing, if the market starts distributing lower, 10, 20 pips, 30 pips lower, we're not chasing it. We're just waiting to see what side of the market is broken first. Generally, that side that is broken, retail traders are chasing. And they're looking for a break retest in that direction. Sometimes they are right, but I want to play the counterparty. I want to be opposite to what they're thinking. Let's play it forward and see what happens. We can see here, this is also a swing high. So something you got to pay attention to. This is a swing high formation right here. That is a swing high that forms 1, 2, 3. That's a swing high. I would mark this off because it still falls inside this time period, 12 p.m. to 8 p.m. This swing point is still a part of this session here. So we're marketing it off. Playing it forward, see what happens. Purge. So price breaks that swing point, that buy side liquidity pool. There's a raid on buy stops. So anybody that was most likely short and they have a potential stop loss here, they have been mitigated, liquidated, knocked out of the market. Their order has been triggered. Here, we're going to stalk a 1 minute setup to go short towards sell side liquidity pool, or at least back to the open and a little lower. That's what we're looking for. We're trying to look from a premium setup to get back down to a discount setup. Sell high and take profit low. That's the sell idea. Let's go on the 1 minute. Now, this entry technique is the one I prefer. There are many other ones out there. I'm just showing the community the one I prefer to stick to because it's not as confusing if I show people 7 different entry models. If I just show one, I can show you how consistent that model is. Let's play it forward. We're looking for a swing low that is going to reside inside the fair value gap. Let's keep playing it until we get one. There we go. We have a swing low, 1, 2, 3. Once again, I'm showing you how to define a swing low in this video. 1, 2, 3. That's a swing low formation. Why? Because this is the lowest candle between 2 points. The candle on the left has a higher low, and the candle on the right has a higher low. There goes the fair value gap right through it. Notice this swing point is inside the fair value gap. It cannot be a swing low that's forming at the start of the fair value gap, or the swing low point is at the end of the fair value gap. It must be in between these 2 points here. We would look to go short. The short scenario would be this. We're looking for a 1-to-1. I like to stick to the 1-to-1 because the 1-to-1s could turn into 1-to-2s, 1-to-3s, 1-to-4s, 1-to-5s, 1-to-6, etc. The potential is unlimited, granted on what happens in the marketplace. Those that know, this night we were robbed of an entry. Let's play it forward. And what do I mean by that? We never got the entry technique triggered. Price never runs into it. However, knowing that if I don't get a short opportunity, I can still look for a long opportunity. With the experience that I have, because I've been doing this for a while and I've seen a plethora of Asian session models and a plethora of Asian sessions in general, studying it, I know that I could potentially still have an opportunity to catch a long if I wasn't able to catch the short. If price returns back up into this level after taking out sell side liquidity, I am not looking to take a short again. That might be a question a lot of people may have. I'm not waiting for price to return back into this fair value gap and to go short. I don't want to see price get back up into here after price gets down here and look for another short. Not at all. I rather look for a buy opportunity. Notice as well where this entry technique is forming. It's forming in a premium above the Asian Open. So if he were to get that, this would have been a sweet trade. However, many people may say, well, Deontay, you didn't get the sell setup. It wasn't successful. Well, take a look. If we're going to look for the long setup, everything is just inverse. We're looking for a fair value gap that runs to a swing high, and that swing high is residing inside the fair value gap. Do we have that? Absolutely. Notice where this entry technique is forming as well. Below the Asian session open in a discount, an oversold condition after taking out that 15-minute swing low. Notice the context. Just because price is below the Asian Open doesn't mean I just start hunting longs. Or just because price is above the Asian Open doesn't mean I just start hunting sells. You may get lucky, of course, but long term, is that going to be something feasible? Not at all. We need context. And the context is we've rated sell side liquidity. And after rating the sell side liquidity on the 15-minute time frame, we got this entry technique. The market produces this fingerprint. It's a very specific fingerprint. Yes, there are other PD arrays here. I know many people may say, "Oh, balanced price range," or maybe order block theory, or smash candle theory by Larry Williams. Many different techniques, of course. But I don't want to confuse people. I want my fellow traders to understand one thing. I don't want you to be a jack of all trades. I want you to be a master of one trade. Master something. Then start to develop other skills. We look for a 1-to-1 scenario. Same idea. Everything I just showed you, but vice versa. And we're looking for a long setup At least back to the Asian Open, or back to what? Those buy side liquidity pools that are still unbroken, clean highs. That's a projection. Let's play it forward. Let's see what happens. Price taps into it. We're in long now, and we hold. And we can see price brings us all the way back up to the Asian Open. Now, this trade idea was successful. And the reason I say it's successful is because we got 10 pips. 10 pips for me is a successful trading day. You can make a career out of making 10 pips per kill zone, per session, etc. If you get 10 pips out of the day, that's great. That means you could possibly potentially get 10 pips out of all the weekdays: Monday, Tuesday, Wednesday, Thursday, and Friday. Now, obviously, that is a perfect scenario, but if you can get 10 pips out of all those days, that's 50 pips in 1 week. That's great. If you could do that maybe twice a week, that's 20 pips a week, etc., etc. The less you do, the more consistency you will see in the marketplace. I don't want to be greedy, so I want to scale out. Someone asked the question, what do I mean by scaling out or taking partials? Meaning, if you took a standard lot, like a one lot, you don't have to close the entire trade. You can close off a portion of that trade. You can close off 80% of that trade, 50% of the trade, 20% of the trade, 10% of the trade, and still hold for higher price action. If you are using a micro lot, you cannot take partials. If you're using a 0.01, you cannot take a partial. The entire trade would collapse and you cannot hold for higher price action, or whether it's a short for lower price action. So if you're someone that's using something higher than a micro lot, you can take partials at 10 pips. Do not be greedy. Pay the trader. You waited all these minutes. You waited a couple hours to get a certain entry. Reward your account. For the sake of your equity, pay yourself. Do not get greedy, because there are many times where the market will give you 10 pips and you don't pay yourself. And what happens? The market does this instead. Market trades. You think everything's all good and dandy. You don't want to pay yourself. And then all of a sudden, you're in drawdown. And then FOMO starts to kick in. And then a lot of psychological pressures start to build in. You start beating yourself up. You start abandoning the model, etc., etc., etc. You don't want to do that. Pay yourself so you can ease your mind. Trading is also a mental game. Notice as well, if we were to get that short set up, man, that would have been a great opportunity, right? We know that the higher time frame trend for the yen crosses are bearish and dollar has been bearish as well. So this would have been a great idea. Counterparty liquidity pool against the higher time frame trend going lower, so it takes out buy side. A short opportunity presented itself. That would have been a sweet opportunity if we were to get the entry. And that's how you see many times where the Asian session model gives you more than 15, 20, 30, 40, 50, 60 plus pips sometimes going into the next day. This is a prime example. We haven't had one in a while, but we will eventually. And you can see it would have happened on a Tuesday potentially. Ideal trading day is Tuesday, Wednesday, Thursday. And for the Asian session model, with the data I know and the experience I have tracking it, Tuesdays tend to be more successful and granting higher reward. We were so close to getting that sell opportunity, but we didn't. But instead, we opted for the long opportunity and we were still able to make something out of that session. Now, I'm not saying every single time you trade the Asian session, you should be looking for both sides. The only time I would look for a long position after a sell position is if I didn't get the sell entry at all. If I were to get this sell entry, I'm only taking one trade. That's it. I'm only looking for one direction. Even though a long position or a long opportunity presented itself, I would not have taken it if I would have gotten this entry. I don't like to take both sides. Yes, you're going to see moments in time where both sides are granted a trade opportunity. Takes out buy side, sell opportunity. Takes out buy side, buy opportunity. I'm not looking to take both. You may want to take both, but I'm telling you, less is more. Less is more. Hopefully, you found this insightful. Peace.